An unsuccessful captive formation, I think, evolves from just a couple of key things. One, it would have to lack, I think, a sufficient degree of risk focus. One that would be done primarily for tax reasons, or perhaps not really fully thinking through the need of the captive, would probably not be successful over time. Certainly one that would be set up as part of a market cycle strategy, that in a hard market you might be able to save money on insurance spend through a captive, is pretty short-sighted. I think the other key reason for a captive to be unsuccessful would be if it lacked sufficient governance and direction from the management of the owner company to really provide the long-term focus and direction. Captives require a strategic plan, an annual plan. It's really execution. Once you're in a captive, you are in the insurance business, and it requires that long-term focus. But all the things I've mentioned can be very much supplemented internally through some service providers that exist in the space. Captive managers, actuaries, CPA firms, lawyers that are very active in captives can bring a lot of that expertise to bear. But there's no substitute for the governance involved and the oversight, and having sufficient risk controls in the captive, both over your liabilities as well as a prudent investment strategy. I think when all those things come together, virtually all captives can be very successful, and certainly been my experience in my career in a variety of organizations that the captives have been very successful tools, both for risk and long-term financial economics.